Charlie Munger once said that the big money is not in the buying and selling, but in the waiting. And in moments like this, patience alone is not enough. What matters is positioning. After decades of watching cycles come and go, bubbles inflate and burst, and new systems replace old ones, the real edge comes from recognizing when the rules of the game are changing. We are standing at one of those moments now. Most investors think the future will look like the past with a few tweaks. That assumption is usually what costs them the most. The next decade will not reward familiarity, it will reward adaptability. The uncomfortable truth is that portfolios built for yesterday's economy will quietly fail in tomorrow's world, not with drama, but with underperformance that compounds year after year. What follows is not speculation or hype. It is a sober look at how capital markets are being restructured in real time, who is positioned to benefit and who is at risk of being left behind if they don't act before the window closes. The inflation of the late 70s and early 80s, the crash of 1,987, the dot bubble 9/11, the financial crisis of 2008, the pandemic, and now we're entering what I believe is the most transformative period I've ever witnessed in capital markets. I'm sitting here, I've been in this business for over 50 years now. Started on Wall Street in 1976. I've seen everything. End 2025 managing over $11 trillion in assets at BlackRock. That's more than the GDP of every country in the world except the United States and China. And from where I sit, I can see something happening that most individual investors are completely missing. A fundamental restructuring of how wealth is created and who gets to participate in it. And here's what concerns me. Most people's portfolios are completely unprepared for what's coming. They're stuck in the old paradigm. They're invested the way their parents and grandparents invested. 60% stocks, 40% bonds, maybe a little cash on the side. And they think they're diversified. They think they're positioned for the future, but they're not. The world has changed. The economy has changed. The investment landscape has changed. And if you don't adapt, if you don't reposition your portfolio before 2026, you're going to miss the greatest wealth creation opportunity of the next decade. That's what I want to talk to you about today. Not theories, not academic concepts, but specific, actionable investments you need to make right now before it's too late, before the window closes, before everyone else figures it out and the opportunities are priced away. I'm going to tell you about 4 critical additions you must make to your portfolio before 2026. These aren't optional. These aren't nice to haves. These are must-haves if you want to build and preserve wealth over the next 10 to 20 years. All right, let's start with what I believe is the single biggest investment opportunity of our lifetime, private infrastructure. And I'm not talking about buying some infrastructure ETF that owns public utility stocks. I'm talking about direct ownership of the actual assets that are going to power the global economy for the next 30 years. Data centers, power grids, ports, airports, fiber optic networks, water systems, energy transmission. These are the backbone assets of modern civilization. And here's what most people don't understand. You can't buy most of these assets on the stock market. They're not publicly traded. They exist in private markets. And historically, only institutions and ultra-wealthy individuals had access to them. But that's changing, and it's changing fast. Let me explain why infrastructure is so critical right now. We're entering what I call the age of electricity. Everything is being electrified. Cars, homes, industry, and on top of that, we've got artificial intelligence, which is the most electricity-intensive technology ever created. A single AI query uses 10 times more energy than a Google search. 10 times. And these AI data centers, they're popping up everywhere. NVIDIA CEO Jensen Huang said it perfectly. He said, we're $150 billion of AI infrastructure into trillions of dollars. We have to go build trillions. That's not a typo. We're talking about the largest infrastructure build-out since the interstate highway system in the 1950s. But here's the problem. Governments can't fund this. Government deficits are at record levels. In the United States alone, we've got over $35 trillion in national debt. In Europe, it's even worse. These governments can't borrow more money to build the infrastructure we need. They're tapped out. So who's going to fund it? Private capital, private investors, people like you and me. Well, actually, people like the clients I manage money for, but increasingly everyday investors too. At BlackRock, we just completed the acquisition of Global Infrastructure Partners, GIP, for $12.5 billion. This was our largest acquisition since we bought Barclays Global Investors back in 2009. And we did it for one reason. GIP owns some of the world's most important infrastructure assets. London's Gatwick Airport, key energy pipelines, over 40 global data centers, water systems, waste management facilities, and the returns on these assets. They're phenomenal, 8 to 12% annually, sometimes more. And here's the beautiful part. These returns are inflation protected because infrastructure revenues, the tolls, the fees, the usage charges, they go up with inflation. If inflation's 3%, revenues go up 3%. If inflation is 5%, revenues go up 5%. Compare that to bonds. If you own a bond yielding 4% and inflation spikes to 6%, you're losing 2% in real terms every year. You're going backwards, but with infrastructure, you're protected. Your real returns are preserved. Now, let me tell you what's happening right now that makes this so urgent. We're seeing a global infrastructure boom of historic proportions. By 2040, the world needs to invest $68 trillion in infrastructure. $68 trillion. That number is so large it's hard to comprehend. Where is that money going? Energy systems. We need to completely rebuild the electrical grid to handle renewable energy, to handle electric vehicles, to handle AI data centers. The current grid was built for a world that doesn't exist anymore. It can't handle the load. We're already seeing rolling blackouts in places like Texas and California during peak usage. Transportation, infrastructure, ports, airports, railways, roads, all of it needs to be upgraded or rebuilt. The American Society of Civil Engineers gives us infrastructure a C- grade C-. We're one of the richest countries in the world, and our infrastructure is crumbling. Digital infrastructure, this is the big one. Data centers, fiber optic cables, 5 grams networks, the physical infrastructure that powers the digital economy. And with AI exploding, the demand for data centers is going through the roof. Microsoft, Google, Amazon, they're spending tens of billions of dollars building new data centers, and they can't build them fast enough. Now, here's what's critical. Most of these infrastructure projects, they're not available through public markets. You can't just go buy shares in a new power grid or a new port. These are private market investments. And for decades, the only way to access them was to be a massive institution or an ultra-wealthy individual. But we're democratizing this. At BlackRock, we're building products that will allow everyday investors to access infrastructure through their retirement accounts, through their brokerage accounts, through ETFs and mutual funds. We're making infrastructure investable for everyone. And this is why you need to act before 2026. Because once these products become widely available, once everyone figures out that infrastructure offers higher returns, inflation protection, and lower volatility than traditional stocks and bonds, capital's going to flood in. And when capital floods in, returns come down. That's just supply and demand. So right now we're in this window, this brief window where infrastructure is still undervalued, still underowned by retail investors, but that window is closing. Over the next 12 to 18 months, I expect we're going to see a massive wave of capital flowing into private infrastructure. And if you're not positioned before that happens, you're going to miss it. How much should you allocate? I'm recommending that investors move toward what I call a 503,020 portfolio. 50% stocks, 30% bonds, 20% private assets, with infrastructure being the core component of that 20%. So if you have a $500,000 portfolio, you should be targeting about $100,000 in private infrastructure over time. You don't have to do it all at once. You can build the position gradually, but you need to begin positioning now, because this is the opportunity. This is where the next generation of wealth is going to be created. Not in public stocks, not in bonds. in the private ownership of the infrastructure that powers modern civilization. And this is where Charlie Munger's wisdom becomes unavoidable. The opportunity is obvious only in hindsight, and by then the price is already adjusted. The next decade will reward those who understand where value is being quietly built, not loudly traded. This is not about chasing returns or timing markets. It is about aligning your capital with the structures that will define economic reality for the next generation. If you wait until this feels comfortable, it will already be too late. The smartest investors won't be asking whether this transformation is coming. They'll be asking whether they acted early enough to matter. Advantages over their traditional counterparts. Lower costs, better liquidity, more accessibility. The tokenization revolution is happening. It's not a question of if, it's a question of when. And those who position themselves early are going to benefit enormously. All right, let's talk about the fourth critical addition to your portfolio, energy infrastructure. And this is where I need to be very clear and very practical, because there's a lot of confusion and a lot of ideology around energy. But I'm not an ideologue. I'm an investor, and I care about what works, what's realistic, and what's going to make money for my clients. For years, I talked about the energy transition, the shift from fossil fuels to renewable energy, and I still believe that's happening. Climate change is real. It's an investment risk, and over the long term, the world is moving toward lower carbon energy sources. But I've learned something important. The transition is going to take much longer and be much more complex than the activists want to admit. Here's the reality. Global energy demand is exploding, not declining, exploding. Why? AI data centers, electric vehicles, electrification of everything, developing countries growing their middle classes, all of this requires massive amounts of electricity. And here's the problem. Wind and solar alone cannot meet this demand. They're intermittent. When the wind doesn't blow, you don't get power. When the sun doesn't shine, you don't get power. And we don't have battery storage technology at the scale needed to solve this problem. Not even close. So what does that mean? We need dispatchable power. Power that's available 24/7, regardless of weather conditions. And right now there are two main sources of dispatchable power: natural gas and nuclear. Let me talk about natural gas first. Natural gas is abundant. It's relatively clean compared to coal. It produces about half the carbon emissions of coal. And it's flexible. You can ramp gas plants up and down quickly to match demand. The United States has become the world's largest natural gas producer. We have decades of supply, and the infrastructure to produce it, transport it, and convert it to electricity is mature and reliable. That's why when Texas built all those wind farms, they didn't shut down their gas plants. They kept them running as backup for when the wind stops. And this is pragmatism. This is energy realism. The most climate-conscious leaders I talk to, and I talk to presidents, prime ministers, energy ministers around the world, they all acknowledge this. They all say the same thing. We need both renewables and natural gas for the foreseeable future. So how do you invest in this? Natural gas infrastructure, pipelines, LNG export terminals, gas processing facilities. These assets generate steady cash flows. They're essential infrastructure, and they're going to be needed for decades. At BlackRock, we have over $300 billion invested in traditional energy firms, not because we're anti-environment, but because our clients want exposure. Because these assets make money, because they're part of the solution, not just the problem. Now, let's talk about nuclear. And this is where I'm really excited, because nuclear is making a massive comeback. For decades, nuclear was out of favor. Environmental activists opposed it. Regulations made it prohibitively expensive. The disasters at 3 Mile Island, Chernobyl, and Fukushima created public fear. But that's changing, and it's hanging fast. Why? Because people are realizing that nuclear is the only carbon F-free source of reliable 247 baseload power. Wind and solar are great when they're available. But when they're not, you need something. And if you care about carbon emissions, nuclear is the answer. Look at China. They're building nuclear plants like crazy. They're building more nuclear capacity than the rest of the world combined. Not because they love nuclear, but because they see it as a competitive advantage. They see decarbonization as a way to dominate the industries of the future: electric vehicles, battery technology, clean manufacturing. And if the United States and Europe don't keep up, we're going to lose. We're going to be dependent on China for the technologies and energy systems of the future. So we're seeing a nuclear renaissance. Small modular reactors, SMRs, that are safer, cheaper, and faster to build than traditional nuclear plants. Companies like NuScale, Terrapin Power, X Energy, they're developing these next generation reactors, and the investment opportunity is enormous. Here's what I recommend. Allocate 5 to 10% of your portfolio to energy infrastructure. Split it between natural gas infrastructure and nuclear technology. You can access this through energy infrastructure ETFs, through master limited partnerships, through specialized funds that focus on clean and traditional energy. And here's the key insight. Energy is not a political issue for me. It's an investment issue. The world needs more energy, a lot more energy. And that energy is going to come from a mix of sources. Renewables where they make sense, natural gas as a bridge and backup, nuclear as a long-term solution, and yes, even some oil for transportation and pyrochemical for the foreseeable future. Companies and investors who understand this pragmatic reality are going to make a lot of money. Those who remain ideological, who think we can shut down all fossil fuels tomorrow and run the world on wind and solar, they're going to lose money because the world doesn't work that way. One more thing on energy. We're also investing heavily in carbon capture and storage technologies that capture CO2 from the atmosphere or from industrial processes and store it underground. We just invested $550 million in Accidental Petroleum's Stratos project in Texas. It's one of the largest direct air capture facilities in the world. Is this the perfect solution? No, but it's part of the toolkit. It's part of a pragmatic approach to reducing emissions while still meeting energy needs. And if it works at scale, if the costs come down, carbon capture could be a gamer. So that's energy infrastructure, natural gas, nuclear, carbon capture, all of it essential, all of it investable, all of it part of a portfolio that's positioned for the reality of the energy transition, not the fantasy. All right, let me bring this all together for you. We've talked about 4 critical additions you need to make to your portfolio before 2026. Private infrastructure, private credit, tokenized assets, and digital currencies, energy infrastructure. These aren't alternatives. These aren't side bets. These are core components of a modern, forward-looking portfolio. And here's how I think about portfolio construction going forward. The traditional 60 to 40 portfolio, 60% stocks, 40% bonds, it's dead. It doesn't provide enough diversification. It doesn't capture the opportunities of the modern economy. It's a relic of the 20th century. The future portfolio, the portfolio that's going to build and preserve wealth over the next 20 years, looks like this. 503,020, 50% stocks, but not just any stocks. You want global diversification. You want exposure to technology because AI is transforming everything. You want EXP, OSHR to emerging markets because that's where growth is. You want low-cost index funds as your core holdings, but you also want some active management in areas where skill actually matters. 30% bonds, but again, not just traditional government bonds. You want a mix of short-term, high-quality bonds for stability and liquidity. You want tips for inflation protection. You want some high-grade corporate bonds for yield. And increasingly, you want private credit in this allocation. 20% private assets. This is the key. This is the game her. This 20% should be split between private infrastructure, private credit, private equity, and real assets like real estate and commodities. These assets offer higher returns, inflation protection, and low correlation to public markets. And within each of these buckets, you want to include the specific opportunities we've talked about. Tokenized assets were available. Energy infrastructure exposure to the AI build-out through data center and semiconductor investments. Now, let me address the elephant in the room. Most people can't easily access private markets. They're not accredited investors. They don't have wealth advisors who can place them in private funds. They're stuck with what's available through their 401k or their IRA. But that's changing, and it's changing because of what we're doing at BlackRock and what other major asset managers are doing. We're democratizing access to private markets. We're building products that will bring infrastructure, private credit, and other private assets to everyday investors through their retirement accounts. This year, 2025, we're launching new target date funds that include private assets. We're working with 401k providers to allow private market allocations. We're building interval funds and tender offer funds that give retail investors access to private strategies. And this is critical because right now, if you look at pension funds, the big state pensions and corporate pensions, they have 20 to 30% allocated to private markets, and they outperform 41k plans by about 0.5% per year. 0.5% doesn't sound like much, but over 30 years, that's the difference between a comfortable retirement and a struggling retirement. So why should only pension funds have access to these better returning, better diversified portfolios? They shouldn't. Everyone should, and that's what we're building. But here's the urgency. These products are coming, but they're not fully here yet. And when they arrive, when they become mainstream, the early movers are going to have an advantage. They're going to get in at better valuations. They're going to build positions before everyone else. So what can you do right now? 3 things. First, if you're an accredited investor, if you have access to private markets through a wealth advisor or through private placements, start allocating now. Don't wait 5 to 10% of your portfolio into private infrastructure and private credit. Do it gradually if you need to, but start. Second, if you're not accredited, prepare. Talk to your 401k provider. Ask them about private market options. Ask them about target date funds that include private assets. Put pressure on them to offer these options. The more demand there is, the faster the products will come to market. Third, educate yourself. Read, research, understand these asset classes, understand why they matter. So when the products become available, you're ready. You can make informed decisions. You don't have to rely on some advisor who may or may not understand this stuff. One more thing I want to emphasize. This is not about getting rich quick. This is not about speculation or taking crazy risks. This is about building a properly diversified, forward-looking portfolio that's positioned. Ed, for the economy and the investment landscape of the next 20 years, not the last 20 years. The world is changing. Technology is transforming everything. Energy systems are being rebuilt. Infrastructure needs are enormous. Private markets are growing faster than public markets. And if your portfolio doesn't reflect these realities, you're going to be left behind. At BlackRock, we're putting our money where our mouth is. Last year, we spent nearly $30 billion acquiring infrastructure, private credit, and data capabilities. We transformed our entire company to position for this future because we see it coming and we're not going to miss it. You shouldn't miss it either. Let me leave you with this. For 400 years, since the Amsterdam Stock Exchange was founded in the 1600s, capital markets have been a democratizing force. They've allowed ordinary people to participate in economic growth, to own a piece of the companies and assets that drive prosperity. But somewhere along the way, we created a 2-tiered system. Public markets for everyone, private markets for the wealthy, and institutions. And that division has contributed to growing inequality. The rich have access to better investments, higher returns, more diversification. The middle class is stuck with whatever is available in their 401k. That's wrong. That's not capitalism. That's oligarchy. And it's our job, those of us in the investment management industry, to fix it, to democratize access, to bring the opportunities of private markets to everyone. Not just the wealthy, everyone. That's what I'm fighting for. That's what BlackRock is building toward. A world where a teacher in Iowa and a billionaire in New York have access to the same investment opportunities. Where your retirement account can own a piece of a data center, a toll road, a power plant. Where the benefits of economic growth are shared broadly, not just narrowly. This is about more than just investment returns, though that matters a lot. This is about economic participation, about ownership, about giving people a stake in the future. And if we do this right, if we truly democratize investing, we can address some of the biggest challenges of our time: the retirement crisis, the wealth gap, the erosion of the middle class. Because when people own assets, when they have a stake in the economy, they feel connected, they feel invested, they have hope. So yes, I want you to add private infrastructure, private credit, tokenized assets, and energy infrastructure to your portfolio. I want you to position yourself for the opportunities of the next decade. But more than that, I want you to understand that you have a right to access these opportunities. You shouldn't be shut out just because you're not wealthy or institutional. The future of investing is being democratized. The walls are coming down. The gates are opening. And if you're ready, if you're informed, if you act now, you can be part of it. The next 10 years are going to be transformational for capital markets and for wealth creation. The question is, will you be positioned to benefit, or will you be stuck in the old paradigm watching from the sidelines? The choice is yours, but the window is closing before 2026 becomes before 2027. And before you know it, the opportunity is past. Don't let that happen. Act now, reposition your portfolio, embrace the future, and let's build this new era of democratic capitalism.